So let's talk about some additional insurance policies to the homeowners and renters we talked about in part one. Let's start with automobile insurance. Automobile insurance is again just a legal arrangement between an individual or a policyholder and an insurance company that protects that individual against risk from automobile accidents. Automobile insurance policies cover liability insurance, medical payment insurance, underinsured and uninsured motorist insurance, physical damage insurance, which includes both comprehension and collision. So let's talk a little bit about a couple of these in more detail. But first, let's talk about uninsured and underinsured motorist insurance. Uninsured and underinsured motorist insurance covers the policyholder if they have an accident where someone else is at fault, but they don't have adequate automobile insurance. So they either are uninsured or they don't have enough coverage to cover all of the medical expenses or damage expenses. Your policy then would kick in and pay for the difference. And now let's talk more about each of those. Liability insurance is going to cover the insured if injuries or damages are caused to other people. Remember, liability coverage covers losses that other people have tied to your property or your actions. So in this case, tied to your car accident. It's the minimum amount required by law if you are driving an automobile. Medical payment insurance covers injuries that are sustained by the driver of the insured vehicle or any passengers, regardless of who might be at fault. It helps pay for those medical expenses. But also cover family members that are injured as passengers in anyone else's car or as a pedestrian or even on a bike. Again, uninsured or underinsured covers any injury or damages to the driver, passengers, or the vehicle that's caused by a driver that doesn't have enough insurance. Physical damage insurance covers damages that are caused to the vehicle that's being driven. That is collision. Collision coverage covers a collision with another object, a car, or from a rollover. So basically, any type of damage to the vehicle that is caused by driving. The other part of physical damage insurance is comprehensive. And comprehensive is going to cover any kind of physical damage or loss to the vehicle that's tied to anything other than driving. So it might be things like hail damage or a tree falling on it, or even just a car hitting it and driving off when it's parked on the side of the road. So why would an individual choose to not have physical damage insurance and only liability? Because remember, only liability is required by law. You aren't required to have physical damage insurance. And sometimes you may choose not to. If your car's not worth very much money and you can replace it for, say, $500 and your premium is $700 a year, it probably makes more sense to just buy a new car. So let's look at some of the factors that impact the premium that you would be paying for your car insurance policy. The type of vehicle that you're covering, whether it's the make, the model, the year, all of those have a role in your premium cost. In addition, if you own a car that is a more frequently stolen vehicle, your premium is going to be higher. Believe it or not, Honda Accords and Toyota Camrys have traditionally been two of the most frequently stolen cars. So even though they're a little less expensive than, say, a sports car might be, they also have a little bit higher policy because they're more likely to be stolen. The newer your car, the more expensive the premium. And if you do have a two-door versus a four-door or anything considered a sports vehicle, it's going to cost you a little bit more in your premium because it's more expensive to replace. The other factors that go in would be the rating territory. So what's the accident rate in the area in which you are driving? Are there a lot of accidents at the subdivision entrance where you live? Also, population in general. The higher the population, the more traffic, so the more accidents. And then we've already mentioned the theft rate. The last factor that they look at would be driver classifications, and that would include age, gender, your marital status, and what kind of driving habits and driving record you have. The younger you are, the more expensive your insurance premium. As In addition, if you're a male, you're going to get hit as a double whammy because young males have the most expensive insurance premiums. They tend to be a little bit more risk takers, and so they drive a little faster sometimes. Statistics show that they're more likely to have an accident at a younger age, and so they have a higher insurance premium because they're more likely to take advantage of that insurance policy. Marital status, some might think that if you're single, it would be cheaper, but actually, marital status decreases as you show that you are married. And the reason why your premium decreases is because most married people are actually safer drivers, which goes to your driving habits and your driving record. When you have a ticket for any reason, placed on your license or your driving record, you typically are going to see an increase in your premium because if you are driving reckless in any way that would require a police officer to give you a ticket, you are more likely to have a claim in the future. Driving habits sometimes are tracked by insurance companies. They can place electronics on your vehicle that actually show your rate of increase in speed from a stop, your deceleration at a stop, and how fast you're actually driving. And those can decrease or increase your premium if you allow them to install it. Let's talk about another insurance type, health insurance. Health insurance provides protection against any financial losses that are resulting from injury, illness, or some type of a physical disability. Policies are going to differ, but most policies cover some combination of hospital stays, surgeries, dental, vision, long-term care, prescription, and other major expenses tied to being ill or being injured. Again, specific coverage is going to depend on your individual policy. Think about why it would be so important to have health insurance. It seems like if you're really healthy and you don't go to the doctor often, maybe it's something that you want to keep out of your budget and save some money. But in reality, if you were to get sick or injured, healthcare costs are extremely high, and those large medical expenses can deplete your savings very quickly, leaving you in a lot of debt and in a situation where you might not be able to recover easily. So it's really important to have health insurance even if you're healthy. You can purchase health insurance as an individual, or a lot of people get it through their employer. And in your case, you probably have coverage through one of your parents because dependents can be added to a parent's or even a spouse's health insurance coverage. Many health insurance policies do offer that dependent coverage, and there's no requirement that they do so. And if they do offer coverage for dependents, children are legally allowed to stay on their parents' health care policy until age 26 without any kind of stipulations or restrictions. So you don't have to be in college, you don't have to be living with them, you can even be married with children of your own. Until age 26, you are able to be covered under your parents' health insurance policy if dependent coverage is provided. So health insurance provides money to pay for health care. It can be provided by the employer, to be purchased by an individual, and or it can be provided by the government. Remember we talked about FICA taxes, and part of FICA taxes was Medicare. Medicare is health insurance that's provided by the government. So you can have any combination of policies being provided for you. Regardless of who is providing the insurance, you typically are going to have these type of risks covered. Again, if dollars are limited and your budget's tight, health insurance is still extremely important to protect against high medical bills because we never know when we might get sick or injured. Let's talk a little bit about some of the costs associated with health insurance. Well, familiar with the term coinsurance, which is the percentage of the expenses the insured has to pay in addition to the deductible based on their policy coinsurance amount. But there's another word tied to health insurance called copayment. Copayment is a flat fee that the policyholder pays every time they receive a covered service. You might be familiar with this when you go to the doctor and you have to pay a flat $20 for that doctor's office visit. That is a copayment. Co-payments are required at the time of service. However, they get added into the total amount you've paid towards your deductible. So they go towards your deductible. So let's look at which policy would you choose. Janet wants to make sure she has the best policy. She shops around and she received multiple quotes. She's looking at the current policy that she has and comparing it to a new policy that she's received a quote from. So let's think about what the pros and cons of each policy might be. In her current policy, she's paying a monthly premium of $300. So she's paying a fee to the insurance company every month of $300. If she has a claim, she will pay a $200 deductible. So out of her pocket, she will pay $200 before the insurance company pays for any of her medical expenses. After she pays her deductible of $200, the insurance company will pay 80% of the rest of the cost, and Janet will be responsible for 20%. The new policy she's considering saves her $100 a month in premiums, so she pays only $200 every month for her policy. But her deductible amount goes from $200 to $2,000. So if she does have a claim, she would be responsible for the first $2,000 out of pocket. After that $2,000, though, she has 0% coinsurance, so the insurance company would pay all of the rest. Which one is the better policy? That's a question that can't be answered by anybody but Janet. When you look at health insurance policies, it's an individual decision based on how often you might go to the doctor, what type of medical expenses you currently have, and what you anticipate might be possible, as well as what you can afford and what kind of an emergency fund you have set aside. So each individual is going to have different factors that they consider when deciding which health insurance policy makes the most sense. So, what happens if a person can't work for some reason, or if they can't live independently? There's actually some insurance policies for that. Disability insurance is a payment that replaces your earnings during a time when you can't work if you are ill or you are injured. So, disability insurance replaces income. It's typically provided by employers. You can also purchase it as an individual, or you can get it through the government as part of the Social Security Disability Act. So remember that Social Security taxes are taken out as part of FICA taxes, and you can qualify to receive disability payments from your Social Security account. So again, disability insurance replaces income when you are not able to work. Long-term care insurance is different. Long-term care insurance pays someone else for your extended care if you cannot live independently anymore, but you're not in the hospital. So you're living in a nursing home or an assisted care facility, or you have someone coming into your house to help take care of you. Those expenses would be paid by your long-term care insurance. Notice that that is not ever provided by employers or by the government. Those policies are purchased by individuals. So again, those are important policies to consider when you're thinking about your financial planning. If you are unable to work, you will need some source of income potentially to pay your expenses. Disability insurance would do that for you. Or if you're no longer able to take care of yourself, unless you have a really large emergency fund, you will need some way of paying for your services to take care of you. So again, disability insurance replaces a portion of your income if you're unable to work. It's typically between 60 and 70% of what your full-time wages were, and they look at factors such as the length or the severity of your disability on what percentage is paid out. Life insurance is different than any of the other two. Life insurance is a contract between an insurance company and a policyholder that specifies a sum that will be paid out to what's called a beneficiary upon that policyholder's death. A beneficiary is whoever the recipient is of any of the policy proceeds if indeed the policyholder passes away. The whole purpose of life insurance is to provide money for family members or dependents when a wage earner dies. The purpose is not to pay for a funeral, which is kind of a misperception. The whole purpose is to make sure that the loved ones you leave behind are able to continue in the lifestyle in which they're used to. And again, remember, a dependent is considered someone who relies on someone else financially. So it doesn't actually have to be a family member if you have someone you are financially responsible for. So with life insurance, the payment is made to the beneficiary if the policyholder does pass away. And that beneficiary is just whoever it is that's receiving the insurance money. You state who the beneficiary is on any life insurance policy that you purchase. And a dependent is someone who relies on someone else for money to survive. You can purchase life insurance through employers at a discounted rate typically, or you can also purchase individual life insurance policies, which is very common. It can cover paid and unpaid work that's formally done by that individual who passed away. So it doesn't always mean that it's only a smart move for someone who is working. You have to also consider what's called household production. So just because someone might be a stay-at-home mom or stay-at-home dad, they are doing unpaid work that is important for the survival of their family and might be saving them money in things like childcare or housekeeping. So if the individual who passes away is unpaid, working from home, doing the childcare, the meal prep, that might be something that now has to be paid for. Someone might have to be brought in to take care of the children or pay for daycare. Those are expenses that would be covered ideally through a life insurance policy. So you don't have to be the one with the job, but you do want to think about whether or not that individual being gone would negatively impact the finances of the family and the dependents left behind. Where do you get insurance? So, most people get insurance from a combination of sources, and we've talked about each of these. Individuals can purchase long term care and property and liability insurance for cars, homes, renters insurance. You can get health, disability, and sometimes life insurance policies through your employer, or you can also get policies through the government for things like health insurance and disability insurance. So even if an employer doesn't provide insurance, you can still acquire it as an individual. If an employer does provide insurance, it's considered part of your employee benefits. It's considered what's called in-kind income. It's a provision of a product or service rather than cash. The employee typically has that premium taken out of their payroll. If you think back to our taxes and income unit, we looked at paychecks, and one of the things that we saw was health insurance premiums being deducted from our gross pay before taxes are calculated. Policies are typically available to the employee and sometimes to the employee's family members, but usually for an additional fee. No income taxes are going to be paid on that in-kind income. So the employer covers part of your insurance premium and does not charge you as if you were receiving the income in cash and had to pay taxes on it. So there is a tax benefit for using your employer provided insurance policies. So in review, insurance is an important and critical part of any financial plan. It's not intended to make the individual better off than before the event happened, just to bring them back to an even playing field. Insurance can be acquired from multiple sources. And even with insurance, an individual still needs to have that emergency fund because they have their deductible and co-insurance that they might be responsible for. And there are all kinds of insurance policies available for very specific purposes. We've just touched on a few of the main ones, but there are insurance policies for many more things. Now I want you to just take a minute on your own and think about what covers each of the risks in the following slides. Hopefully now you have a better understanding of why insurance is such a critical part of any financial plan.